Good afternoon, everyone. Welcome to your next session of Audit and Assurance, where we are going to continue from where we left in the last class. So if you remember in the last class, what did we do in the last class? We had already seen a lot of chapters, and in the last class, we had seen the systems and controls chapter, right? We had seen as to what is internal control. We had seen what does an auditor do with respect to internal control. What does he do? He ascertains information about that system. He gets to know about that system. He then documents that system in the form of flow chart, in the form of narrative notes, in the form of internal control questionnaire and internal control evaluation questionnaire. So he documents that system and he evaluates that system. And before this, we had also seen the components of internal control system. And in order to remember them, I told you, remember the acronym CRIME, CRIME, correct? I told you to remember CRIME, the acronym CRIME. What does CRIME mean? C there means control activities, right? These are components of internal control system. C is control activities. R is risk assessment process. Whose risk assessment? Entity's risk assessment process, not the auditors. We are not talking about audit risk here. We are talking about internal controls, right? We are talking about the risk assessment process that the entity has, that the management has. So risk assessment process, R for risk assessment process. I for information system. What is the information system of the company? M for monitoring of controls. How are you monitoring the internal controls? And E, control environment. CRIME, CRIME. Then after that, we had also seen the different systems, like the sales system, the cash system, the the purchase system, the inventory system. Did we finish all the systems? I think we had. I think we had done it. Can you confirm once? Did we see all the systems? Let me show you the document also so that you can also recall. 1 second. I'm a little confused because I have two classes going on simultaneously. So I'm confused whether all the systems I've explained to you or not. I think we have done a question also, right, on internal controls. On internal controls, I think we had seen one question also, right, where I showed you how do you identify the different kind of direct controls from a case study, right? From a case study, how do you identify the different kind of direct controls, and how do you identify the deficiencies in those internal controls? Did we do a question like that? Did we do a question like that where we saw how do you identify basically the various internal controls from a given case study, and how do you identify the deficiencies in internal controls, the problems in internal controls? Did we see a question like that? Should I show you that question? 1 second. Let me open that specific question itself. Let me see the page number first. Bhumika says we did it. Others, do you remember? Because that question is important. The question of Raspberry. I told you to see the answer of it as a homework also. Correct? Let me once just open it for you. I told you the answers for it will be a homework that you will do. And I had given you another question also as homework, which was Caterpillar. Yes. See this question. Have we not seen this question? The payroll system of Raspberry company. We discussed, right, that 70% of the employees are working in production. They are being paid in cash. 30% is working in production, in offices. They are being paid in bank. There is a separate HR department and there is a separate payroll department, right? So we said that this is segregation of duties. So it is an internal control because duties have been segregated between the payroll department and the HR department. Clear? Do you remember that we've seen this question? Can others also confirm? Was only Bhumika listening to this question? Yes, Apeksha also remembers. And what about the homework? Did anybody do the homework? Did you see the answer for this question? And did you also see your caterpillar question that I gave you as homework? Basically, the next question itself. I'll show you that also. Yes, this question I had given you as homework, right? Question number 223 at page number 115. Question number 223 at page number 115 was given to you as a homework. It's a similar kind of question where again a case study is given and you are asked to identify the different internal controls, the different direct controls, write test of controls for each direct control, and write the deficiencies in internal controls, the problems which are there in those internal controls. Clear? Can we move to the next chapter, or do you have any doubts? Do you have any doubts while you read the question or the answer while doing the homework? Did you get any doubts? Or can we move to the next chapter? I need your confirmation. Without your confirmation, I can't. No doubts? Are you guys there? Are you guys attending the class also, or you just switched on the class and you're doing something else? I ask you questions and you guys don't respond. Do you have any doubts in this chapter? Do you have any doubts in the questions that you've seen as homework? All right. So there's no response. I don't know what to infer from that. Should I infer that you guys have understood everything? Or should I infer that you guys have not understood anything? So I don't know which one of them should I be inferring from no response. Okay. So I will move on to the next chapter. Let me open the study text for you. So we've completed systems and controls chapter, right? Now we're moving to next chapter, which is about audit procedures. Should I show you once as to what are the chapters that we've already completed? Yes. Look at the index. We've already done from chapter 1 to chapter 8. From chapter 1 to chapter 8, all of those chapters are done, 1 to 8. Now we're moving to 10th chapter. We're moving to chapter 10, procedures. Internal audit is a small chapter. Internal audit is not a very big chapter. It's a very small chapter of about just 10 or 15 pages. So internal audit chapter we will come back to if we have time in the last class or tomorrow's class. We will come back to internal audit if we have time. But right now, let's move to a very important chapter, which is procedures, right? Now, which is also a very long chapter in terms of the information that it is trying to give you, right? If you see the page numbers also, it's starting at 333, whereas the next chapter is starting at 405. That means there are about 75 pages in this chapter. So of course, it's going to be a long chapter, chapter 10, procedures, correct? But if you understand things clearly, if you remember something that we've already done, remember evidence chapter, and if you listen to the introduction of this chapter, if you listen to the introduction of procedures chapter very carefully, the entire chapter can become a little easy for you. The entire chapter can become a little easy for you. But for that, you need to recall what have we done in evidence, and you need to listen to the procedures chapter introduction very carefully. Okay, now let's go to the procedures chapter. So what does this procedures mean? These procedures mean what? Mean audit procedures. These procedures are nothing but what? These are nothing but audit procedures. Now, what about audit procedures? Why are you doing audit procedures? You tell me. Why are you doing audit procedures? The audit procedures that an auditor does, why is he doing these procedures? What is the reason behind doing audit procedures? Anybody? What is the reason? Or What is the objective over, or what is he trying to do by doing audit procedures? Audit procedures, as I told you, is a synonym word which is used for substantive procedures also. Yes, Niranjan Ramprasad says that it is to gather evidence. Very good. Why do you do audit procedures? You do audit procedures in order to gather evidence. Evidence about what? Evidence is the correct answer, but evidence about what? You're trying to gather evidence about what? Evidence about what? Evidence about whether the financial statements that you're looking at, whether the financial statements are free from material misstatements or not. Correct? You're trying to gather evidence about whether the financial statements that you're looking at, whether the financial statements are free from material misstatements, whether the financial statements are giving you a true and fair view of the financial position and the financial performance or not. Correct? You are looking whether the financial statements are giving a true and fair view or not. True and fair view of what? True and fair view of the financial position and financial performance. Where did we see this? In chapter number 1. Correct? In chapter 1, we've already seen this, that an auditor's objective is to what? He's trying to gather evidence. Evidence about what? Evidence about whether the financial statements are giving a true and fair view. True and fair view of what? True and fair view of the financial position and the financial performance of the company. Correct? Okay. Now, if you remember, we've already seen some procedures. We've already seen substantive procedures that an auditor does in order to collect evidence. We've already seen substantive procedures that an auditor does in order to collect evidence. Does anybody remember? I had given you an acronym there. I'd given you a short form in order to remember all of the substantive procedures or all the audit procedures that an auditor does. And at that time also I told you that these are going to be the base for your procedures chapter. For your procedures chapter, these are going to be the base. You're going to use these procedures, substantive procedures. What was the acronym? That means you're not writing in your notes. Nobody is maintaining notes. Nobody is writing running notes. Rio car. Don't you remember? R triple I R I O CAR. Now at least do you recall? Rio car. What was R there? R was recalculation. I was inspection of documents. Again, I was inspection of tangible assets. One more I was inquiry. O was observation. C was confirmation. A, analytical procedures. And R, reperformance. Correct? Have we not seen Rio car already? RIIIOCAR, Rio car. Those Rio car is what? That is nothing but audit procedures. Those are nothing but substantive procedures or audit procedures that an auditor does in order to collect evidence. Evidence about what? Evidence about the various financial statement assertions. Right? You're doing these procedures, you're doing Rio car for what? For getting evidence about the financial statement assertions. What were the assertions? I told you assertions can be divided into balance sheet items and P&L items. And for balance sheet items assertion, I again gave you an acronym. What was that acronym? What was that short form? For financial statement assertions, the balance sheet items, the account balances. For account balances, what was the acronym? What was the short form? Don't tell me you forgot. I've told you this three times at least. Yes, Apeksha is Apeksha good. So CWOP. What was the acronym that I gave you? CWOP. CEAVOP. Right? What was C there? Completeness. E, existence. A, accuracy. V, valuation. O, rights and obligation. P, presentation and classification. P, presentation and classification. Did we not discuss all of this? All of those are balance sheet items assertions. What about transactions in events, the P&L item assertion? There also there is completeness. Existence becomes occurrence. Accuracy remains same. There's no valuation. There's cutoff and presentation and classification. So remember them, right? So an auditor, in order to do for you, in order in the exam also, in the exam, if they are asking you to write procedures, what should that procedure contain? That procedure should contain what is the procedure, that means what is the action, what is the procedure or what is the action, what is the objective of that action, that means the assertion that you're testing, what is the objective of that action that you're doing, what is the objective of that procedure. Objective is nothing but the assertion. Which assertion are you testing? Are you testing completeness, existence, accuracy, valuation, rights and obligation, or presentation and classification? One of these assertions only you check when you do your audit procedures. So every audit procedure, you will write what is the action, on what source are you doing that action, and what is the objective. Listen very carefully. In every procedure, what will you write? What is the action? Action, you will take it from REOCAR. What is the objective of that action? That you will take from CWOP. And what is the source on which this action is being applied? What is the document on which that particular audit procedure or that particular action is being applied? All right. Okay. Now, let's go into this chapter and let's read about procedures. See, writing good audit procedures. Read there. An audit procedure should be a clear instruction of how the audit evidence is to be gathered. It should be a clear instruction of how are you gathering your audit evidence. Next, it should contain three things. It should contain an action applied to a source. It should contain a source on which you are applying that action to achieve an objective. To achieve an objective, it should contain basically these three things, the procedures that you're writing. It should contain an action, that means the procedure. What is the procedure? That comes from REOCAR. Out of REOCAR, which action are you applying? On what source are you applying that action? What is the source? And what are you achieving? What is the objective that you're achieving? Objective is nothing but CWOP. Objective is nothing but the assertions that you have already seen. Great. Now, let's see some examples of good audit procedures and a bad audit procedure. See this example. See this example. First, see what is the objective. As I told you, objective will always be related to what? Objective will always be related to your one of the assertions, financial statement assertions. So see the audit objective in this example. To test the existence of non-current assets, E of CWOP. You're trying to test what? You are trying to test the existence of the non-current assets as to whether the non-current asset actually exists or not. In order to check whether a non-current asset actually exists or not, what can you do? You can do a physical inspection, right? You can do inspection of the tangible assets, your I of REOCAR. What action can you do? You can do inspection, physical inspection. You can physically inspect those fixed assets. Those non-current assets, which are tangible assets, you can go and physically inspect them. Now, as an auditor, you only think, will it be possible for you to check all the fixed assets which are there with the company? Is it possible Let's say you are the auditor of Reliance Industries Limited. Now, if you are the auditor of Reliance Industries Limited, will it be possible for you to check all the fixed assets of Reliance Industries Limited? They might be having like lakhs of assets, right? They might be having lakhs and lakhs of fixed assets. It will not be possible for you to check all the fixed assets. So what do? You check only a sample of assets. You check only a sample of assets. Now, how will you check sample of assets, or which sample will you choose, or what is the population from your where you will choose? Because listen very carefully. What will you get from the client? From the client, you will first get the balance sheet and the P&L, right? You will get what? You will get a balance sheet and the P&L from a client. Now, in that balance sheet, fixed assets, a cumulative amount will be written, right? Let's say plant and machinery, and let's say the company has 25 different plant and machineries. Now, the value of those 25 different plant and machineries, each machinery value, the breakup of each machinery will not be given in the financial statements, right? In the balance sheet. In the balance sheet, the value of all the 15 plant and machinery put together will be given. Correct? I hope you know this. You must have seen, right? You must have prepared some balance sheets. So in that balance sheet, you will not prepare separate, or you will not have separate, values of each plant and machinery, right? A plant and machinery cumulated amount will be given. Similarly, if there's a building, let's say there are 7 buildings that the company owns, all the 7 buildings cumulative amount will be included in building in the balance sheet. So what do you need? You need a breakup of the assets. Correct? You need what? You need a breakup of all the 15 assets, all the 15 plant and machineries, along with their location as to where are they located. The company can have multiple factories and multiple offices. So where is that fixed asset located? You need that information, right? You need the information of where is each asset located and what is the value of each asset. So what do you get? What do you ask from the client? You ask from the client a non-current asset register. Remember, what do you call? You ask from the client a non-current asset register or a fixed asset register. Remember, you get from the client a non-current asset register. What is this non-current asset register? This register is basically going to give you a breakup of all the different fixed assets, a breakup of all different fixed assets, of all single fixed assets also. A breakup will be provided to you. A breakup of all the different fixed assets will be provided to you, along with the values of each fixed asset and their location. As to where are they located, what's their location. That is a non-current asset register. Basically, the company is making a register, the company is maintaining a register where they are keeping the details of all different fixed assets that they have. All the different plant and machineries, all the different buildings, the details of that, along with their location and values, will be given a non-current asset register. So what should you do? You should get that non-current asset register first from the client. From the client, get that non-current asset register. Then select a sample of the assets from this non-current asset register and then physically verify or physically inspect them to verify their existence. Right? The sample of assets, let's say you selected some 5 plant and machinery and 2 buildings. Then you will go and physically inspect whether those 5 plant and machinery and those 2 buildings actually exist or not physically. Whether they actually exist or not physically, you're going and seeing them. That's physical inspection. So this is a good answer. See, this is what you should write for audit procedure if you're testing the existence of the non-current asset. This is a good answer. See the bad answer? Check a sample of assets. For that, will you get any marks? Can you write a procedure like that? Check a sample of assets. No, it's very vague. It's not descriptive at all. It's extremely vague. If you write check a sample of assets, you're not going to get marks for that. You're obviously not going to get any marks for that if you write check a sample of assets. What should you write? You should write that you're selecting a sample of assets from what? From a non-current asset register and then physically inspecting them to verify existence. So see, you have what? You have action, you have the source, and you have the objective. All three of them should be present in the procedure. In the procedure, all three of them should be present. There should be an action, a source, and objective. Action here is physical inspection. Source is the non-current asset register. Correct? Action is physical inspection. Source is the non-current asset register. And objective is to verify existence. That we already know. So action, source, and objective, all three of them should be present in your answer. Great. See the next one. The next example of a good procedure and a bad procedure. Audit objective. What is the objective? Objective is to test the valuation of trade receivable. What do you want to check? You want to check whether the value of the trade receivables which is given in the balance sheet, is that correct or not? Is that correct value or not? The value which is being shown as at the year end in the balance sheet. Whether that value is correct or not. That's valuation. Now, how do you know whether that value which is being shown as at the year end, whether it is correct or not? Now, as I told you earlier also, when do you do audit? You do audit after the year end. Let's say the year end is 31st December 2022. If the year end is 31st December 2022, you are going to do your audit after the year end when the draft financial statements are ready, right? So let's say you're doing your audit in February last month. You're doing your audit in February last month of the balance sheet as at 31st December 2022. Now, the value that they're showing for receivables, let's say for A, for person A or for Mr. A, let's say they are showing 2,000. For Mr. B, let's say they are showing 15,000. For Mr. C, let's say they are doing 20,000. So how will you make sure whether this 2,000, 15,000, 20,000, whether they are correct amounts or not? Whether the value of them is correct or not. How will you know that? You should go and see after the year end, what payments have you received? You must have received the payments, right? From A, from B, from C. Why? Because generally, the credit period which is given to these parties is 1 month. Generally, the credit period which is given to the parties is 1 month, right? So by February last week, these parties must have paid you the amounts, must have paid the company the amounts outstanding, right? So how can you measure or how can you test whether the value of the trade receivables, whether the valuation of trade receivables as at the year end is correct or not? You can see the post year end payments. You can check after the year end the payments which have happened, right? Because after the year end, the payments which have the payments which have been received from the receivables, if it is matching to the year end balance, then of course that year end balance's valuation is correct. But if the opposite person, if the receivables has still not yet paid after the year end also, if that person has still not yet paid, then what should you do? As an auditor, you should see whether there is a whether there is a requirement of creating a provision for bad and doubtful debt. If the opposite person, the trade receivable, if he is not paying you, if you're not receiving any payment from the opposite person, then you should check, is there a requirement for creating a provision for bad and doubtful debt? Should you create a provision for bad and doubtful debt, allowance for receivables? Correct? So see, good answer. Inspect the post year end bank statement to identify if the payment has been received post year end. If so, agree the amount to the receivables ledger at the year end. Correct? You are checking whether the payment has been received after the year end or not. That is the inspection that you are doing for valuation of trade receivables, to test the valuation. See the bad answer? Perform a receivable circularization. What is receivable circularization? Getting external confirmations from your debtors. Getting what? Getting external confirmations from your debtors. Confirmations was one of the substantive procedures, right? One of the audit procedures was what? Confirmation. That you're getting a confirmation from the receivable as to what is the balance in their books. As to what is the balance in their books, right? Because you have your books. In your books, that person is a debtor. But in the opposite person's books, you might be a creditor, right? Because you have made sales to him, so you will record that person as a receivable. For him, it is purchases. For that person, for receivables, it is purchases. So he will also record those entries and there will be a creditor. Now, the entries that he is recording and the entries we are recording should be similar but on opposite sides, right? He will also record similar entries. He will also record the purchase or sale. He will also record the payment or receipt. Correct? So the balance should be matching. So what are you doing? You're performing a receivables circularization. You're performing a receivable circularization for a sample of customers. But receivable circularization you can do to test which assertion? To test existence as an assertion and not valuation. Very important point. Listen very carefully. You can do receivable circularization, but receivable circularization is done for checking which assertion? You are checking the assertion of existence and not valuation. Within CWOP, you are checking whether that opposite person which has been listed as debtor in this company, whether that person is existing or not. Whether that opposite person, whether he's actually existing or not. That's what you're checking. That is what you're checking as to whether the opposite person actually exists or not. Right? Because if that person is a fictitious party or a fake party that the company has recorded, let's say the company wanted to increase the amount of sales. So they have created a fake party to whom the sales are being made. If it's a fake party, that circularization will not be replied to, right? That confirmation letter will not be replied to. That is why the receivable circularization is testing for existence. Why not for valuation? Not for valuation because even if the balance matches, let's say we are showing 40,000 receivable and the opposite person is also showing 40,000 payable. But does that mean only because he's showing 40,000 payable, does that mean he will definitely pay? Or there is no doubt about whether he will pay or not? No, right? Him showing a payable of 40,000 does not mean that there is every possibility that you will receive that amount. There might be a possibility that that person is going bankrupt, that that person is going insolvent, and he will not be able to pay. And he will not be able to pay you. But still he's showing a payable of 40,000 and you're showing a receivable of 40,000. Now, will that receivables will that 40,000 as receivables, will that be a correct representation? No. You should create a provision for bad debts and reduce that 40,000 because the opposite person is turning insolvent. That is why the receivable circularization, which is confirming the year-end balance with the opposite party, that does not test the assertion of valuation. That is only testing the assertion of existence as to whether the opposite person exists or not. That's it. Whether the opposite person exists or not. That's it. It is not testing anything about valuation. Clear about receivable circularization? So for valuation, what should you do? If you want to check whether the value of the trade receivables is correct or not, you should check that that trade receivable might have been received after the year end, right? Check whether you have received that amount. Check whether the company has received that amount after the year end. Clear? If you want, please note this point down that for valuation, for testing valuation, you'll have to check post year end balances. But for checking existence of trade receivables, for that you do receivable circularization. What is receivable circularization? External confirmations. So note that point down. I'm coming back in a minute. Note that point down. By that time, I'll come back. Done? Done noting it down? Can we continue? These are just some examples of how do you write procedures, correct? These are telling you what? These are just telling us what are the things that you should keep in mind while writing procedures, right? You should keep in mind that the procedure should have an action, a source on which you are doing that action, and an objective that is being achieved. Objective that is being achieved is related to what? Objective which is being achieved is related always to your assertions. To your assertions. Clear? There's no response today. I don't know what has happened to you guys. At least in last classes, there were some people who were responding. Today, though, everybody's like almost like ghosting me. You guys are very tired, is it? Are you guys very tired, or are you guys not interested anymore in ACCA classes? What's the deal? What's bothering you? Okay. Now, let's go to the next point, which is called directional testing. Now, what do you mean by directional testing? This topic is dealing with as to in which direction are you going when doing a procedure that determines which assertion are you testing. The direction in which you are going while doing a procedure that determines as to which assertion are you testing. For example, when you're testing the assertion of existence of fixed asset, we just saw, right? We just saw an example above. In the example above, we saw, right, that when you're testing for existence of a fixed asset, when you're testing for an existence of fixed asset, what were you doing? You were going and seeing, or you were selecting some fixed assets first from the fixed asset register, from the books of accounts, and then going towards the physical assets and physically inspecting them. So what is the direction that is happening here? The direction is from the books of accounts to an external source. Listen very carefully. In the above ordered procedure, in the example that we saw, what did we see? We saw that in order to test existence of the fixed assets, existence of non-current assets, what were you doing? You were selecting a sample from the non-current asset register, and then those sample of assets, you were going and physically inspecting them in order to verify their existence. So what is the direction here? The direction is moving from the books of accounts to the external source. Correct? The direction of your testing is moving where? It is moving from the books of accounts to the external source. And what are you trying to see here? You are trying to see whether the company has included some, assets which are actually not existing, right? Testing for existence means what? Testing for existence means you are checking whether the company that you are looking at, whether that company has included some fixed assets in their balance sheet which have actually which are actually not there. Some fake fictitious assets they have included which are actually not present, which are actually not existing. So what are you testing? You are testing as to whether the balance sheet or whether the fixed assets value is overstated or not. Correct? You are testing whether the fixed assets value is overstated. What do you mean by overstated? More than what it should be. Whether the value of fixed assets, whether it is more than what it should be, whether the management has included some fake assets, some fictitious assets in order to increase the value of the assets. And how are you testing whether the amount is overstated or not? By checking for existence, by checking whether it actually exists or not. That's how you can check, right? That's how you can check. So let's go and read overstatement first, then we will come to understatement. See, testing for overstatement. A balance will be overstated if the items are included that should not be included. Some fake items, some fake fixed assets have been included, but they should have actually been not included. Some items have been included which should not have been included, or an item which has been included is recorded at an amount which is higher than it should be. Right? An item is recorded at a value. It is recorded. It's not like, it should have been recorded. So it is recorded, that item, but the amount that you've recorded, it is higher than what it should be. So this is overstatement. And when you're testing for overstatement, what are you doing? Read. When you're testing for overstatement tests the assertions of existence, rights, obligations, occurrence. Existence and occurrence are similar, right? Existence and occurrence, they go both are similar. Existence is for balance sheet items, occurrence is for P&L items. And accuracy and valuation, you're also checking accuracy and valuation. Okay, next, see, to test for overstatement, the auditor must select the sample from the accounting system and then trace that transaction to the supporting documentation. Right? What was your direction of your testing? You started from the financial statements. You started with what? With the balance sheet. From the balance sheet, you went on to the fixed asset register, the non-current asset register. And then you took a sample of the assets from the non-current asset register and then traced it back to the physical assets, to the source, to the external source. So this direction, when you're doing this direction, you're testing for existence or overstatement. For existence or overstatement. Right? Okay. See the example there. For example, from the sales day book, they have taken an example of sales. Like we have taken the example of fixed assets. They have taken an example of sales. See what are they doing? From the sales day book, select a sample of sales invoices and trace to the actual sales invoices and related goods dispatch note to confirm occurrence. Like we took balance sheet item fixed assets. That is why existence was the assertion that we are testing. Since they have taken a P&L item, since they've taken a transaction or event or sales, for them, which item is coming? That is a P&L item. So that is why which assertion is coming? Occurrence is coming instead of existence. Instead of existence, occurrence is coming. Great. The reverse of this will be what? The reverse of this will be testing for understatement. What do you mean by understatement? That means everything which has happened, whether that has been recorded or not. Everything which has happened all the transactions and events which have happened, all the fixed assets which are there, whether they have been all recorded or not. Which assertion are you testing? That means which assertion are you testing? If you're testing that everything which has happened that has been recorded or not, which assertion are you testing in here? You're testing the assertion of completeness. Completeness and existence are basically moving in reverse directions, right? So when you started from the financial statements and then went to the external source, you were checking for existence or occurrence. But if you go reverse, reverse means what? Reverse means when you start with an external source and then when you come to the books of accounts, you're checking for completeness. For example, if I'm selecting a sample of physical assets, if I'm an auditor and if I'm selecting a sample of physical assets, and those physical assets, if I'm tracing it back to what? To the financial statements to see whether they have been recorded or not, what am I doing? I am checking for completeness. I am checking for completeness as to whether everything, all the fixed assets which are actually physically existing, whether those fixed assets have been recorded or not in the financial statements. Whether those fixed assets, whether they have been recorded or whether they have not been recorded in the financial statements. So I'm checking for completeness here as to whether it has been completely recorded or not. Testing for completeness means what? Testing whether the financial statements are understated. Testing whether the fixed assets are understated. Correct? Okay, so let's read. See, testing for understatement. A balance will be understated if items that should be included are not included, right? Items which should have been included, they are not included. That means the balance is not complete. Or an item which has been included is recorded at an amount lower than it should be. There was an item which should have been included, but it is recorded at an amount which is lower than it should be. Okay. So what are you testing? You're testing the assertion of completeness here. There you were checking for existence and occurrence. Here you're checking for completeness. Accuracy and valuation remains the same for both of them. You don't have to remember that. You don't have to remember that. See, example that they've given. To test for understatement, the auditor must select the sample from outside the accounting system and then trace the transaction to the accounting system. The reverse of what did we see earlier. So you're selecting some physical assets, some sample of physical assets, and tracing it back to the financial statements to see whether all of those fixed assets that you've selected, whether those have been recorded in the financial statements or not. Whether all those fixed assets, whether those have been recorded in the financial statements or not. That is checking for completeness. So they have given us an example of sales. See, what do you do? For example, select a sample of goods dispatch note and trace it to the related invoices and then into the sales day book. So you're selecting some goods dispatch note and some invoices. You're relating those goods dispatch note to the invoices. Those are the external sources. From those goods dispatch note and invoices, you're moving towards the books of accounts. You're moving towards the accounts, the financial statements. Then it is called checking for completeness. You will be confirming completeness here. Correct? So it depends of what is the direction of testing, which will determine whether it is completeness or is it existence and occurrence. It depends from where are you starting. Are you starting from your books of accounts or are you starting from an external source? Okay. Clear? Understatement, overstatement. Anybody has any doubts? Just imagine in your head that if you're starting from your financial statements and then going to the external source, that means what are you doing? You are checking whether what has been recorded is actually there or not. That means existence and occurrence. Whereas if you're starting from the outside source and then moving to the financial statements, You're looking at whether all of these things have been actually recorded or not in the books of accounts. That is a check for completeness. So it's logical, very logical. It is definitely very logical. It has logics. Okay. Now we'll move on to see the various audit procedures that an auditor does with respect to the various balance sheet items and the P&L items. So first we'll see different balance sheet items, and then we will also move on to see the P&L items, the various P&L items, and we will see the audit procedures that an auditor does for all of these items. For all of these items, what are the audit procedures that an auditor does? We will see all of them. What are going to be the balance sheet items that we are going to see? We're going to see bank and cash. We're going to see non-current assets. We're going to see tangible and intangible assets. Those are non-current assets. We're going to see trade receivables, inventory, your trade receivables, your inventory. These are assets. What about liabilities? You're going to see long-term liabilities or long-term loans. You're going to see long-term liabilities or long-term loans. You're going to see trade payables. You're going to see trade payables. You're going to see equity share capital, share premium. So all of these, all the items which are there in the balance sheet, you as an auditor should check them, right? You should make sure that the amount which is being shown in the balance sheet for all of these items, whether that amount is true and correct or not, true and fair or not. As an auditor, your responsibility is to do that, right? Okay. Now, first, let us discuss bank and cash. And then we will move on to the other balance sheet items. First, as I told you, we'll finish the balance sheet items. Then we will go to P&L items. Okay. Bank and cash. See the different sources of evidence that you have for bank and cash. Imagine, put yourself in the shoes of the auditor. Put yourself in the shoes of the auditor. You become the auditor. Imagine that you're the auditor. Imagine you're the auditor, and imagine you have received the financial statements from your opposite company, from your client. From your client, let's say you've received the financial statements. Now, in that financial statements, let's say the amount of bank and cash which is being shown is 60 lakhs. As at the year end, as at the last day, the bank and cash, the amount that they're having in bank or in cash in hand, the total of both is being shown, let's say, at 60 lakhs. So now, how do you get to know whether that 60 lakhs amount is correct or not? How do you get to know whether that 60 lakhs amount which is being shown as bank and cash, whether that is correct or not? What do? You do audit procedures for that and have key assertions as your objective of the audit procedures. But these audit procedures that you do, they are going to be done on sources of evidence, right? There should be an action, a source, and an objective in the audit procedure. In the audit procedure, there should be an action, a source, and an objective. Correct? So see, sources of evidence. For bank and cash, what can be the different source of evidence? One can be bank confirmation letter. From bank, you can receive what? A bank confirmation letter. Like circularization. We must have studied circularization, right? We must have studied confirmation as one of the substantive procedures. C out of car. So you're going to perform, you're going to get bank confirmation letter. That can be a source of evidence. Apart from bank confirmation letter, which the banker will give you, they can also give you bank statements. Along with the bank confirmation letter that they're giving you, they can also give what? They can also give you bank statement. I hope everybody has seen their bank statements, or anybody else's, like your father's or mother's or business's bank statement. Have you seen it anytime? Seen a bank statement? No? Never seen a bank statement? Yes? What does that bank statement contain? It contains all the transactions that have happened during that period. Correct? It will contain all the transactions that have happened during the year, all the deposits, all the withdrawals, all the payments that have been made, all the receipts of the amount that have been directly received. All of them will be included in that bank statement. So that bank statement is a source of evidence. The bank confirmation letter that the banker is sending, that confirmation letter is an evidence. BRS is an evidence. The bank reconciliation statement. Why do you prepare BRS? Because most of the times the amount which is being shown in the bank does not match with the amount which is being shown in the books. Why do you think that difference can come? You tell me. The amount in the bank statement, the year-end amount in the bank statement, the amount which is there in the books of accounts, these two amounts, they don't match generally. Why? And this is the reason why you do BRS. But what is the reason that they don't match? Your bank book in the books of accounts should ideally be matching with the bank statement, right? But it doesn't. Why? And that's why you're doing BRS. Why do you do BRS? Or what is the reason behind reconciling your bank balance as per your books of accounts to the bank statement? What is the reason? The reason for the difference between your books of accounts and the bank statement is nothing but there can be checks in transit. There can be what? There can be checks in transit. For example, let's say I issued a check on 30th December 2022. I issued a check on 30th December 2022. In my bank book, as soon as I issued the check, I will deduct the amount, right? Since I've issued the check, since I've made the payment in my bank account, I will reduce the amount. In my bank account means what? In the bank book or the bank account that I'm maintaining for the company. Correct? If I've issued the check. But let's say as at the year end, as at 31st December, let's say that check has still not been sent to the bank for collection. The check which you have sent, you have already sent it to the client, but the client has still not sent to his banker for the purpose of collection of this check. Correct? So for that, what do? This is what? This is a check in transit. Checks issued but not presented for payment. You must have heard this word. You must have heard this word, right? Checks issued but not presented for payment. That means you have issued the check, but the opposite party has still not presented that check in the bank account. Right? You have already issued the check, but the opposite party to whom you've issued that check, he has not yet transferred that check to the bank. That means that check is issued but not yet processed. It has not been presented for payment yet by the opposite party. Similarly, there can be the reverse situation also. What is the reverse situation? Check received but not sent for collection. Let's say you've received a check. Let's say you've received a check. Now, when you receive the check, you record that in the books of accounts, right? When you receive the check, when you had received the check, you will record that check in the books of accounts that you've received that particular check. Correct? But that check has still not been sent to the banker for collection. That check has still not been sent for bank for collection. So that means there will be a difference between your accounts and the banker's accounts. Because banker, the balance in the banker does not involve this amount which has been received now, which has been not sent for collection as at the year end. So because of these reasons, there's a BRS that you prepare. This is the background of why do you prepare a bank reconciliation statement. Okay. Read these paragraphs briefly. They are very generic in nature. We have discussed most of them. Read these paragraphs. Let me know once you're done. Let me know if you have any doubts in any point. You can leave the last paragraph, read the first three. Read the first three paragraphs. Last paragraph, it's okay. You can leave that. That's not very important. Done? Now, what we'll do is we'll go and see one of the examples, one of the questions, so that you get to know as to how do you write your procedures. And you need to see this question carefully, because you need to remember all of them. The procedures that we are going to see. Yes, see this question. See, the BRS is given to you. A bank reconciliation statement is given to you. And they are asking you, describe the substantive procedures that the auditor should perform to obtain sufficient and appropriate audit evidence in relation to Murray Company's year-end bank balances. In relation to the year-end bank balance, what are the different substantive procedures? What are the different audit procedures that you can do? Right? So, of course, you will have to remember all of the procedures, because a similar kind of question can be asked in the exam. In the exam also, they can ask you, describe audit procedures for bank balances. They can give you any BRS. It's not necessary that they have to give the same BRS, or they might not give you a BRS. They might not give you a BRS. And I hope everybody must have seen a BRS in your accounts. In accounts, in the accounts subject, you must have seen a bank reconciliation statement, a BRS. Can anybody confirm that? In accounts subject, did you see BRS already? Okay. Thank you, Nitin. So now a BRS has been given to you. It starts with balance as per cash book. You're taking a balance which is as per cash book. You're adding to that unpresented checks. What are unpresented checks? Checks which have been issued but not presented for payment. Checks that you have issued. Now, when you issue the check, you must have reduced the cash balance, right? When you must have issued the check, when you have given the check, you have reduced the cash balance, thinking that you have already given the check. But that check has not been presented for payment. It is unpresented right now. It has been, if it is unpresented, that means in the bank balance, the amount has not been reduced. In the bank, the amount has not been reduced yet, because that check has not been presented. So what do? You add that to the balance as per cash book in order to arrive at the bank statement balance. In order to arrive at the bank statement balance, you're adding that amount back. Next, less outstanding lodgement. What are outstanding lodgements? Checks received but not sent for collection. If you want to write it down, write it down. Outstanding lodgements are checks which have been received, but they have not been sent for collection. They have not been sent for collection. So when you receive that check, you must have included that amount in the cash book, right? When you receive that check, you must have increased the value of your cash book because you've received a check. But now that check has not been sent for collection as at the year end. That means in the bank statement, that amount is not there. So reduce that amount from the cash book. From the cash book, you will reduce outstanding lodgement. So this is the information that the client has provided to you. Now you as an auditor, you tell me what audit procedures will you perform? What audit procedures will you perform? Okay, let me tell you the first audit procedure. This is the first audit procedure which I'm going to tell you. It's going to remain mostly the same for many of your different items that we're going to see. Many of the different items that we're going to see, like fixed assets, trade receivables, this first point is going to remain the same. And what is the first procedure? Now, the company has given you a bank and cash balance, right? What did the company do? The company has given you a bank and cash balance in the balance sheet. Now that bank and cash balance will have a breakup, right? What will happen? That bank and cash balance, which is being shown in the balance sheet, that bank and cash balance can have a breakup. So you can obtain what? You can first obtain the breakup of the bank and cash balance, which is being given in the balance sheet, to see what are the different multiple accounts, what are the different multiple bank accounts which have been included. What are the different bank accounts, the multiple accounts which have been included with one particular client. Okay. All right. Now let's read the procedures. See the audit procedures that you do for bank and cash. Read. First one, obtain the BRS, the bank reconciliation statement, and cast to ensure arithmetical accuracy. What do you mean by cast to ensure arithmetical accuracy? Cast to ensure arithmetical accuracy is nothing but check the amounts in the BRS for their arithmetical accuracy. That means check them for addition, subtraction, multiplication, division. The amounts which have been added and the amounts which have been reduced, was the calculation done correctly or not of that addition, subtraction? So you're casting it for arithmetical accuracy, that BRS. Cast for arithmetical accuracy. Cast to ensure arithmetical accuracy. Remember this term. This term will be used at a lot of times in this chapter. What term? The term cast to ensure arithmetical accuracy. Cast to ensure arithmetical accuracy. Great. Next, obtain a bank confirmation letter from the Murray bankers to confirm the existence and rights and obligations. What are you obtaining? The confirmation letter. You're obtaining the confirmation letter from whom? From the banker. This is what? C of your Rio car. C for confirmation. C of your Rio car is confirmations, right? So you're receiving confirmations from your banker, the banker of the client. So from that banker, you're receiving a confirmation letter, a bank confirmation letter. Next, agree the balance as per cash book on the reconciliation. That means in BRS, you have balance as per cash book, right? That balance as per cash book, agree that. Agree means what? Match. The word agree means match. So match or agree that balance to the year-end cash book and the financial statements. That amount should match with what? That amount should match with the year-end cash book, the cash book of the company, and that amount should match with the amount which is being reflected in the financial statements, right? The amount which is being shown in the balance sheet as cash in bank. So you're agreeing the amount which is being shown in the BRS to the cash book and to the financial statements. Next, similarly, agree the balance as per bank statement to what? To the year-end bank statement and to the confirmation letter. You are agreeing the balance as per bank statement to the original bank statement and to the confirmation letter, the banker's confirmation letter. Great. Next, what do you do with outstanding lodgements? Also, let me highlight things so that you remember. Remember, CAS 2, ensure arithmetical accuracy, obtain a bank confirmation letter, agree the balance as per cash book, the balance as per bank statement. Next, trace all the outstanding lodgements. What are outstanding lodgements? Checks received but not sent for collection. So you're tracing all the outstanding lodgements to the pre-year end cash book, because in cash book, it will be there in this year. Post-year end bank statement, because in bank statement, the amount is going to be received in the next year, right? For this person. So you are checking with pre-year end cash book. These lodgements will be cleared post-year end. So you're checking with also post-year end bank statement, right? Okay. So outstanding lodgements, you're checking with the cash book and the post-year end bank statement. Next, like you had outstanding lodgements, another thing that you have is unpresented checks, right? Checks which were issued but not presented for payment. Like you have outstanding lodgements. Similarly, you have checks issued but not presented for payment. Same thing you will do here also. Same thing you will do here also. What will you do? The unpresented checks, you will agree them or trace them to the pre-year and cash book and the post-year and bank statement. Right? Okay. Next, examine any old unpresented checks to assess if they need to be written back into the purchase ledger to confirm accuracy, valuation, and completeness. You will examine any old unpresented checks, checks which were issued, but they have not been presented yet. And that check is going to expire, let's say. And that check is going to expire because every check will have a validity period, right? In India, what is the validity period of the checks? Can you tell me? For how many days is the check valid? A check which I'm issuing today, by today's date, can it be collected next year? Or when does the check expire in India? The validity of any check is 3 months, guys. The validity of any check is 3 months, correct? From the date of the issue till 3 months, the check is valid. But if that check is, yes, 90 days or 3 months, both are same. 90 days or 3 months, 13 to 3 is 90. So 90 days or 3 months, if that check has crossed 90 days also, if there is an unpresented check and it has been crossed 90 days year mark also, correct? Then what do? Then you write back that check in the books of accounts. You will write back that check. So read, examine any old unpresented checks to assess if they need to be written back. Let me highlight. Right? Okay. Next, inspect the bank confirmation letter for details of any security provided by the company or any other legal or right or set off, as this may require disclosure. So you're inspecting what? You're inspecting the bank confirmation letter. The bank confirmation letter that you're receiving from the banker, apart from the balances which are there in separate accounts, it will also give details about the security of the company that the company has left or the company has given to the banker. Right? So you will inspect that also. You'll inspect the bank confirmation letter for any details of any security provided by the company, as this may provide disclosure. Next, details of security I will highlight. Review the cash book and bank statements for any unusual items or large transfers around the year end, as this could be evidence of window dressing. You will review what? You're going to review the cash book and the bank statement for any unusual items, for any extraordinary items of large transfers. And lastly, you can count the petty cash in the cash at the year end and agree the total balance included in the financial statements to confirm accuracy, valuation, and existence. What can you do? You can count the petty cash which is available. The cash which is available in the shop. You can count that petty cash uh, to agree that petty cash to the balance included in the financial statements to confirm three things: accuracy, valuation, and existence. Yes, clear. Any doubts in these bank and cash procedures? Do you have any doubts in the bank and cash procedures? No doubts? Should we take a break and then come back and then discuss the other items? Bank and cash discussion is over. What did we see in bank and cash? I'm again explaining it to you. Try to recall. Try to remember these points. You're obtaining a BRS. You're casting it for arithmetical accuracy. You're checking whether the addition, subtraction, everything has been done correctly or not. So you're casting it for arithmetical accuracy. Next, you're obtaining a bank confirmation letter from the banker. Next, you're matching the balance as per cash book and BRS to the cash book and financial statements. You're matching the balance as per bank statement and BRS to the bank statement and to the bank confirmation letter. Next, you are tracing all the outstanding lodgements, correct, to the pre-year and cash book and the post-year and bank statement. Next, trace all the unpresented checks which were issued but not presented for payment. Trace them to the pre-year and cash book and post-year and bank statement. Next, if there are any old unpresented checks, while doing your tracing, if you find any old unpresented check, then what will happen? Then assess if they need to be returned back. Assess if these old unnecessary checks, whether these need to be written back in the books of accounts. Next, you will inspect the bank confirmation letter for details of any security given. Has the company given any security to this banker? Like a loan. When you take a loan, will the banker give you the loan for free? No, the banker will ask you for some security, like your building, like your house building or your furniture and fixture or your plant and machinery or your factory building. They will ask what they are going to ask you to do what? They are going to ask you to provide these properties as security. If it's small property, then small security will be enough. Okay, next, review the cash book and bank statements for any unusual items. And last, count the petty cash in the cash tin at the year end. At the year end, after every, you can do it after every 15 days also. But as an auditor, at the year end, you're doing that thing to check how much is the petty cash which is present in the financial in the company and how much is being reflected in the financial statements. Okay. So this was about bank and cash. We still have to see a lot of items. We still have to discuss a lot of items like fixed assets, trade receivables, trade payables, long-term loans. We have to discuss all of them. What we'll do is we'll take a small break now. It's been it's 3:30, almost 3:30, no, on 3:26. It's 3:26 right now. So I will switch on the timer and you come back whenever the timer ends. Do not exit the room, just remain in the room. Come back when that timer ends. So take a break. Yes, so we are back from the break. Before the break, what did we discuss? Before the break, we had discussed about bank and cash. We had discussed about cash and bank, and we've seen that for cash and bank, what audit procedures can you perform as an auditor? As an auditor, what are the different procedures that you do for bank and cash, and how do you basically identify and how do you write down the different procedures? As I told you, you'll have to remember these procedures for every item which has been listed in the study text, right? Like bank and cash, there are audit procedures. You'll have to remember them. Similarly, For let's say non-current assets that we are going to see. For non-current assets, there are audit procedures. For trade receivables, there are audit procedures. For inventory, there are audit procedures. So for most of the items of balance sheet, there are audit procedures. Then we will move to P&L items also. Now let's move to the next item of your balance sheet. Let me go back to the study text. One second. Yes. So we've finished bank and cash. Now let's move to the next item, which is non-current liabilities. When you are auditing a client, and in that particular client, you have non-current liabilities. That means you have a non-current liability. Can you, what is an example of a non-current liability? A loan which is outstanding. An outstanding loan, a loan which is outstanding, a long-term loan is a non-current liability, right? Now, this long-term loan, will it be shown under non-current liabilities, or will it be shown under current liabilities, or will it be shown under both? You tell me. This non-current loan, will it be shown under current liabilities, or will it be shown under non-current liabilities, or will it be shown under both? You tell me. Under which head is this long-term loan usually shown as? Under which head do you show this? Your long-term loan. I've got one answer. Sonika says non-current. What about others? This long-term loan, do you show only under non-current? No, you will show both under non-current and current. The portion of the loan that is going to be paid in the next 12 months. The portion of the loan that is going to be paid in the next 12 months from the balance sheet, that will be shown as a current liability, right? The installments, the principal, which is due next year in the next 12 months, that will be shown as a current liability. The remaining portion, the portion which is due after the 12 months, that will be shown as non-current liability. That means that specific loan, that long-term loan that you have, that has to be divided between current and non-current liability. The amount has to be divided between current and non-current liability. The portion of the loan that is going to be paid in the next 12 months, that portion you will show as a current liability. Whereas the portion of the loan that is going to be paid after 12 months in the next years, that will be shown as a non-current liability. Remember this. And as an auditor, what will you do? As an auditor, you'll have to check this point. As an auditor, you have to check, you have to make sure that the company has correctly divided the non-current loan into the non-current liability and the current liability, the long-term loan into current and non-current liability. Whether that division has been done correctly or not, that's the job of the auditor to check. Okay. Now, for a loan, for a non-current loan, what are the different sources of evidence? There's a loan agreement. There will be a loan agreement, right? The loan that you've taken from the bank, if you've taken a loan, you'll have an agreement with that banker. In that agreement, all the terms and conditions will be mentioned. Correct? In that agreement itself, all the terms and conditions of the loan will be mentioned. So that loan agreement is a source of evidence. Your cash book is a source of evidence. Because when you've received a loan, you must have recorded in your cash book, right? Similarly, when you're paying the loan, when you're then afterwards, when you have to pay the principal back, when you're paying the loan back afterwards, that also will be recorded in the cash book. Similarly, these entries will also be there in bank statements, because the loan receipt, the loan disbursal, and the loan repayment is done through bank. So it will also be there in the bank statement. And you can get a bank confirmation letter. Just like how you were getting a bank confirmation letter for the cash and bank balance, which was giving you a balance which is there of the current accounts or of the savings account which the company has. Similarly, the banker can give you a confirmation letter which will reflect the amount of loan outstanding. The loan that you've taken from the banker For that, you can get a bank confirmation letter as at the year end, which will reflect, the banker is going to reflect what is the amount of the loan which is outstanding as at the year end. That will be there in that bank confirmation letter. Okay, great. So these are the different sources of evidence. Now, let us go and see what are the different procedures that you perform. Okay, firstly, listen to me first. Listen to me. Firstly, what do you have as an auditor? You will have a balance sheet, right? As an auditor, you will have a balance sheet of the client. Now, in that balance sheet, you're looking at the non-current liabilities. Under non-current liabilities, there is an amount of loan which is mentioned. Now, if the client has multiple loans, if the client has multiple loans, those multiple loans will not be listed separately in the balance sheet, right? If the client has multiple loans, if the client has different loans, those multiple loans will not be mentioned separately in the balance sheet. In the balance sheet, what will you have? In the balance sheet, you will have what? In the balance sheet, you are going to have a cumulative amount. You'll have an amount which includes all the loans put together. So what should you get first of all? You should get first of all a breakup of those loans or a breakdown of all the loans. You should obtain what? You should try to get, or you should obtain a breakup of all the loans, a breakdown of all the loans which have been outstanding at the year end. You should receive a list of all the loans which are outstanding as at the year end. You should receive a breakup or a breakdown of all the loans outstanding, and then cast it to verify arithmetical accuracy. What do you mean by cast to verify arithmetical accuracy? The same thing which we've seen in cash and bank balance. You are going to check whether the addition, subtraction, whether that has been done correctly or not, whether that has been done accurately or not. And the total of this breakup should be matching with financial statements. So agree the total to the financial statements. So obtain a breakdown of all the loans, cast it to verify arithmetical accuracy, cast it for arithmetical accuracy for additions and subtractions, see if it is arithmetically calculated correctly or not, and agree the total of this breakup. The total of this breakup should match with your financial statements. Great. Next, agree the balances outstanding to the bank confirmation letter. The balance which is outstanding as at the year end, that will match with the bank confirmation letter, right? So match it. Matching is nothing but agreeing. That's why you're using the word agree here. So use these kind of terms. When you're writing audit procedures in the exam also, use these kind of terms. Use the term agree, use the term cast to verify arithmetical accuracy. So use these kind of terms. Next, inspect the bank confirmation letter for any loans which have been listed that have not been included in financial statements. You're starting from an external source. You're taking a bank confirmation letter. You're seeing what are the different loans which are listed here. Then you're checking whether they have been included in your financial statements or not. So this direction, what are you checking? Of course, completeness. If you're going in this direction, you're checking for completeness, right? You're inspecting the bank confirmation letter. Next, you inspect the bank confirmation letter for details of any security over assets and agree this to the disclosure. Your bank confirmation letter will also have the details of security given to obtain this loan. Because in order to obtain a loan, you have to give some security, right? Like you have to give, for example, if you want to get a house loan, what do? You have to give that house as a mortgage, as a security, as a mortgage or as a security. So you are going to give that particular asset as a that particular asset which has been given as a mortgage will be listed down as a security in the bank confirmation letter. Okay. Next, inspect the financial statements for disclosure of interest rate and the split between current and non-current. I told you, right, that the loan, that long-term loan has to be divided between current and non-current. So inspect that split between non-current and current, whether that has happened or not. Next, recalculate the split between current and non-current. You can also again calculate it, right? So recalculate that split between current and non-current. Oh, I missed out highlighting the important things, right? Let me highlight. You're obtaining the breakup. You're agreeing the balance to bank confirmation letter. You're inspecting the bank confirmation letter for anything which have not been included in financial statements. You're inspecting bank confirmation letter for any details of security, and you're inspecting financial statements for disclosure of interest and the split between current and non-current. Correct? Okay, next. You are inspecting the loan agreement for any restrictive covenants. What do you mean by covenants? Covenants means terms and conditions. The word covenant means what? The word covenant means terms and conditions. So you're reading the loan agreement to see whether there are any restrictive terms and conditions or not, restrictive covenants, and determining what will be the effect if the company breaches any of the terms and conditions. If the company is breaching any condition, if the company is not following any terms or conditions, then what happens? What happens in the case of such breach? You will determine the effect of that, right? So you're inspecting the terms and conditions of the loan agreement. Next, you're inspecting the cash book for loan repayments made. For the loans, the repayment of the loans that have been made during the year, those repayments will be reflected in the cash book, right? In the cash book of the company. So you're checking the cash book for the loan repayments. Next, for the related finance cost in the statement of profit or loss, recalculate the interest charge and any interest accrual in accordance with the terms and conditions with the loan agreement to ensure arithmetical accuracy. What are you doing? You're recalculating the interest amount. For that loan, the company might be paying interest, right? So recalculate the interest amount. Recalculation is one of the substantive procedures. In Rio car, the first R is recalculation. If you remember, the first R in Rio car is recalculation, where you're doing a calculating work. So recalculate the interest charge and see whether that matches to the interest recorded in the financial statements, and see is there any interest which has been accrued but not paid. Correct? You will calculate the interest amount and see whether the entire amount of interest has been paid or not. Because the amount of interest which has not been paid yet, that will be accrued interest. It will be interest accrued but not yet paid. Correct? That guy, that particular amount should be shown as a current liability, accrued interest or interest payable. Correct? So see that also. Okay. So this is about long-term loans or non-current liabilities, the different audit procedures that you do for long-term loans or for your non-current liabilities. These are the procedures that you perform as an auditor. Great. Now, let us move to the next area, non-current assets. Like we saw non-current liability, now we are going to see the non-current assets. Non-current assets are nothing but your fixed assets. Non-current assets or your fixed assets. Let's see. Sources of evidence. What are the different sources of evidence for your non-current assets? As I told you already about one source, your non-current asset register or the fixed asset register. The company, the client has to maintain a non-current asset register, right? A fixed asset register. That non-current asset register that the company is maintaining, that fixed asset register that the company is maintaining, that is also a source of evidence. What does this register contain? It contains the details of each of the assets. It contains the details of each of the different fixed assets with their individual values and their location. Correct? And their location as to where are they located. Is that asset at the factory? If it is at the factory, which factory? If the company has multiple factories, which factory is that particular fixed asset located at? Or is it in an office building? Right? So the location of the fixed asset will also be mentioned in that non-current asset register. So that's a source of evidence. In the last year, during the last year that you are checking, the year that you're auditing, in that year, there might be multiple purchases and sales, right? Purchase of fixed assets, sale of fixed assets. So from where can you check these purchases and sales of the last year? You can see their purchase invoices and sales invoices. When you've purchased a fixed asset, the opposite party will give you an invoice, right? When you're purchasing a fixed asset, the opposite party will give you an invoice. Similarly, when you're selling a fixed asset, you will either issue an invoice or you will have a capital disposal form. You can issue an invoice when you sell a fixed asset also, or you can have a capital disposal form. And the amount that you're paying for purchase of fixed asset or the amount that you're receiving for sale of fixed asset, those amounts will be reflected where? In the bank statement. The amounts will be reflected where? The amounts will be reflected in the bank statements. So you can check what? You can check the bank statements to see the amounts which have been paid or the amounts that you have received. Great. So bank statements and cash book. Next, physical assets. You can also, the physical assets themselves, the fixed assets which are physically there, the physical assets themselves is also what? That is also, again, a source of evidence for you, because you can go and physically inspect as to whether those fixed assets are existing or not. So that physical asset itself is one of the source of evidence. Next, ownership documents like title deeds, registration documents. For example, if the company is showing land in their balance sheet, if a company is showing land as one of their fixed assets, then what will happen? That land should be owned by the company, right? They should be the owner of that land. Then only they can show that particular amount as what? That particular amount as their land, as their fixed asset. So what? How can you, ensure that? You can take the land deed. You can take a land deed as an evidence. There will be a land deed, right? So take a land deed, and that land deed will be like what? That land deed will be, one second. Why is my hand raised? I think it's recognizing gestures. Right? One second, guys. How do you lower this hand now? Okay, whatever. So that land deed that you're getting, that land deed is again what? It is a proof that the company is the owner of that land. So you can get title deeds like that. Also, you can get registration documents. For example, like you have for cars, for motor vehicles, for bikes, you have, whenever you, if you buy a motorcycle or a motor car, you have a registration certificate, right? You have an RC. You have a registration certificate or an RC, correct? That registration certificate or that RC is what? It's again a proof that you are the owner of that particular vehicle. So if a company is showing a motor vehicle in their books of accounts and their fixed assets, you can check the RC of that motor vehicle to see whether the company has the RC in their name or not. Correct? That registration certificate, that RC, should be in the name of who? It should be in the name of the company. Then only the company can be showing that particular amount as their, that particular motor vehicle as their fixed asset. Okay. So ownership documents, depreciation policy, and capital expenditure budgets. These can be the different sources of evidence for you. On these sources of evidence only, you will perform different audit procedures. Let's see the audit procedures now. Let's go and see the audit procedures. The procedures are in Test Your Understanding 2 answer. So I'll go to Test Your Understanding 2. One second. Yes. Look at the procedure. What's the first thing that you should do? Similar to the non-current liability. Non-current liability, what did you do? You obtained a breakdown of all the loans. Listen carefully. You obtained a breakdown of all the loans. You cast it for arithmetical accuracy, and the total you agreed to financial statements. Same thing you can do for non-current assets also, because non-current assets also, you have non-current assets in your balance sheet. Like you have buildings, so and so amount, land, so and so amount, plant and machinery, so and so amount. But that land, that building, that plant and machinery will contain multiple plant and machineries, right? There can be more than one building, more than one land. But the amount which is being shown in the financial statements, that's a cumulated amount. That's a cumulative amount, correct? So you will obtain what first? You will obtain a breakdown. You will obtain a breakdown of all the different fixed assets. Where is that breakdown? That is there in non-current asset register. So rather than writing obtain a breakdown of all the non-current assets, you can just write obtain non-current asset register, because that non-current asset register is nothing but the breakdown, right? So obtain the non-current asset register, cast it for arithmetical accuracy, cast it to see whether it is arithmetically accurate or not, and agree the total of that to the financial statements. The same point that we saw in your what do you say, non-current liabilities also, correct? Okay, next, select a sample of assets from the non-current asset register and physically inspect them. You're going to check existence. You're selecting a sample of assets from the non-current asset register and then going and physically inspecting them, physically seeing whether those exist or not. Next, you can do the reverse of it, right? If you do the reverse, the direction will change and you will check for completeness. See the reverse? Select a sample of assets visible and inspect the asset register to ensure they are included. You are checking the assets which are visible to you, whether those assets have been recorded or not. Whether those assets have been recorded or not. Okay. Next, inspect the assets for condition and usage to identify signs of impairment. You can inspect the assets that you're looking at. Physically inspecting means what? You're looking at those assets, right? So see whether, see the condition of the assets and see the usage to see if there's any impairment. Is there any requirement of recording an impairment of the assets? Impairment, I'm sure you must have studied in your accounts, right? So first one was obtain a non-current asset register, select a sample of them from the non-current asset register and physically inspect them. Then select a sample of assets visible at the premises and see whether they have been recorded. Then inspect their condition for impairment, see whether there's a requirement of impairment. Next, if there was any revaluation during the year for revalued assets, the assets which were revalued during the year, what should you do? You should get a valuation report. You should get a valuation report to check the value that the company has taken. Revaluation means what? That means the company must have revalued it to the fair market value, right? Now, you are not the expert person to talk about fair market value. So you can take the help of an expert and that expert will give you a valuation report. That expert can give you a valuation report. So get a valuation report for the revalued assets and check whether that revalued amount matches to that report or not, agrees to that report or not. Next, obtain the list of additions and for a sample, agree the cost to supplier invoice. The additions that were made during the year, those additions means what? Purchases. Those purchases of fixed assets, you can agree them or you can match them with the supplier invoices. Rather than writing the word match, write the word agree. Correct? Okay. Next, select a sample from the list of additions and review the description to confirm that they relate to capital expenditure and not repairs and maintenance. The additions to fixed assets which were made during the year, select a sample of them and see the description of those assets on the invoice to make sure that they are capital expenditure only and not repairs and maintenance. Because if something is repairs and maintenance, that should not be included in the fixed assets value, right? If something is repairs and maintenance, that should not be included in the fixed assets value. So check that. Next, inspect a breakdown of repairs and maintenance expenditure to identify any items of capital nature. The reverse. In the next one, what are you doing? You're inspecting the various expenditure which is there in repairs and maintenance and seeing if anything should be capitalized. If anything should be capitalized. Okay. Lastly, for sample of assets, inspect the supplier invoices, the title deeds and the registration documents, like the land deeds and the RCs that we discussed. We've already discussed this point, right? Like land will have land deeds, title deeds, and your motor vehicles will have registration certificates. So check these land deeds, registration certificates to ensure that the name of the client is present in them, right? Then only the client can be called as the owner of them. Okay. Then for sales, the sales which have happened during the year, for disposals, what do? You obtain a breakdown of disposal, cast it for arithmetical accuracy, and agree these assets that they've been removed from non-current asset register. Next, you will select a sample of disposals and agree them to sales invoices. Agree that to sales invoices. Next, you can recalculate the profit or loss on disposal. You can recalculate the amount of profit or loss on disposal. Great. So this was about what? This was about non-current assets. These were the different procedures that you can do for non-current assets. Any doubts or anything that is worrying you? Do you have any doubts, or is there anything that is worrying you or something that you're not understanding? Please let me know now. No doubts? Okay. Next, let's quickly also discuss depreciation. This is a P&L item, but still, since it is related to non-current assets, we can discuss it. Depreciation is what? Depreciation is actually a P&L item, but let's discuss this because it's related to non-current assets. See, depreciation. What should you do as an auditor? You should inspect the capital expenditure budget for the next few years to assess the appropriateness of the useful economic lives. The economic life, the useful economic life that the company has taken, you should check whether that useful economic life, the number of years that the company has taken as useful economic life, whether that is appropriate or not. How will you check whether that is appropriate or not? You can check the useful economic life with the capital expenditure budget. Because an asset, if the company is using, let's say, that asset only for 5 years, that means what? After 5 years, they'll replace that asset with another asset, right? For example, laptops. Let's say the company has bought laptops today. How will you know what is the useful life of the asset? You should look at the capital expenditure budget. You should look at the budgets of the next years to see when is the company again spending for laptops. As per the budget, when is the company going to again spend for laptops? When are they again going to buy laptops? So when you check that, then you will get to know that what is the useful life of the asset. You will get to know from that as to what is the useful life of the asset for that particular company. Next, review the profit or loss on disposal of asset to assess the reasonableness of depreciation policies. Because if the depreciation policy is reasonable, if your policy of depreciation is reasonable, then what should happen? Then there should not be any substantial profit or loss. There should not be any substantial profit or loss, correct? The profit or loss should not be a great amount, because the amount in the market will match to the books of accounts. That is when you can say that the amount of depreciation which has been calculated was appropriate. Next, compare the depreciation rates to companies with the same type of assets. You can compare the rates of depreciation of this company with another company. Next, you can recalculate the depreciation that we know, or you can perform a proof in total calculation. And lastly, you can review the disclosures in the financial statements about the depreciation policy. About the depreciation policy, what are the financial statements disclosures which have been made? Clear? This was about depreciation. This was about depreciation. Okay. Now, let's go back and move towards the next area. Non-current assets is done. Let's go back. One second. Yes. The next area is inventory. The next area is inventory. The amount of inventory which the company is showing in their balance sheet. As an auditor, how are you going to check that amount? How are you going to make sure that the inventory that they are showing, whether that amount of inventory is correct or not? So see, the different sources of evidence that you have for inventory. You have an aged inventory listing. What is this aged inventory listing? It is nothing but the list of all the different inventories that the company has along with their age. What do you mean by age? The number of days for which the company is holding that inventory. Age of an inventory is what? Age of an inventory is nothing but the number of days the company is holding that inventory. That is the age of inventory. For example, if the company is a trading company, that means the company is purchasing finished goods and selling finished goods. If the company is a trading company where it is purchasing finished goods and selling finished goods, from the date of purchase of finished goods, from the date of purchase of finished goods, you will start your age till the finished goods are sold. If that finished good was purchased, let's say 3 months back, what is the age of that inventory? 3 months. For how many days was that inventory outstanding? For how many days are you holding that inventory? That is nothing but the age of the inventory. Okay. Next, inventory asset. The asset itself. The asset itself is what? Is again a source of evidence. You can go and physically inspect. Next, inventory count sheets. The inventory count which the management has to do. The company has to do what? The company has to do an inventory count. They have to count what is the inventory, what is the number of inventory which is there in the warehouse. So that you will get in the inventory count sheets. Next, purchase invoices. You must have purchased inventory. For that, purchase invoices are there. Then sales invoices, goods receive notes and goods dispatch notes. When you purchase inventory, there will be goods receive notes. When you sell the inventory, there will be goods dispatch notes. Right? So these can be the different sources of evidence. All right. Now let's go and see the different audit procedures that you can do for inventory. So one second. This is test your understanding 3. Yes. See, for inventory. Now, the procedures for inventory are divided between 3 things. Some procedures you do before the inventory count. Let's say the company is performing an inventory count and you are going to the company and attending that inventory count. So before attending that inventory count, you will do some procedures, you will perform some procedures. During that inventory count, you will perform some procedures. And at the final audit stage, you will again perform some procedures. So that is why the procedures, the audit procedures for inventory are broken down into 3 stages basically. It is broken down into 3 different stages. See this, before the inventory count, before attending the inventory count, what should you do? First one, contact the client to obtain the copy of the inventory count instructions to understand how the count will be conducted and assess the effectiveness of this count process. The inventory count, which is being done by the management, which is being done by the company. Now that company, the directors of the company or the senior management of the company will give out what? They will give out some instructions of the count, right? Instructions as to how the count should be conducted. So you are obtaining those instructions and understanding that whether that process, whether those instructions are effective or not, whether the process of inventory count is going to be effective or not. Next, you're reviewing working papers obtained from the previous auditor to understand the inventory count process and any issues that should have been taken into account this year also. You are reviewing the last year's working papers, because last year also inventory count must have been done. Like you're doing like the company is doing inventory count this year. Last year also inventory count must have been done. Last year also the auditor must have joined the inventory count. So see his working papers, the auditor's working papers from the last year. Next, you can contact the client for details of date, time, and location of inventory count. Where is that inventory count happening? What is going to be the date? What is going to be the time for that inventory count? You can obtain details about that. Is there a lag in my voice and the video? Do you see any lag in the voice or the video? Because I can feel a little lag. Now I think it's gone. Can you hear me clearly, or is there a lag between what I say? Are you listening to it late, or is there a lag? No? Okay. Next, obtain a list of locations where inventory is stored and select which locations will you attend, right? Because it might be possible that you as an auditor, you might not be able to attend all the locations inventory count. There might be probably, like, let's say Reliance Industries will have thousands of locations, right? There are thousands of Reliance stores. So that's why you'll have to select which stores are you going to attend the inventory count. Okay. Next, consider, is there any need for expert? Do you need the help of an expert in valuing the inventory? Next, ascertain whether any inventory is being held by third parties. See whether any inventory is being held by third parties. And lastly, request direct confirmation from the third party if any inventory is being held at third party warehouses. This can be a possibility, right? Sometimes you don't have enough space in your own company. So you will give your inventory to any third party warehouse, and that warehouse is keeping the inventory of the company. So you can get a confirmation from that third party warehouse. Great. Next, during the count, what do you do? Now, during the count, when the inventory count is going on, what do you do? See, observe the count to ensure that the inventory count instructions are being followed. Right? You are going to observe the count to ensure that the instructions which were given by the management, whether those instructions are actually being followed or not during the count. Okay. Next, inspect the count sheets to ensure they have been completed in pen and not with pencil. The inventory count sheets which the people who are counting the inventory, they'll have inventory count sheets, right? Those inventory count sheets which the people have, they should not be filled up with pencil. Why? Because if they are being filled with pencil, what can happen? Afterwards, they can manipulate that. Afterwards, they might be able to manipulate those things. They might manipulate and change whatever they've written in that count sheet. Correct? Okay. Next, inspect the count sheets to ensure the description of the goods is there, but the quantities are not there. Right? The quantities should not be mentioned. The quantities is to be written by the person who's filling up that sheet. Already, in that printed sheet, only the description should be given. not the quantities. Next, re-perform a sequence check to ensure that none of the count sheet are missing. See whether all the count sheets are present. Next, inquire of the counting staff which department they work in to ensure that they are not warehouse staff. The warehouse staff should not be allowed to do inventory count, right? Because again, there is a chance of manipulation. So inquire as to whether that counting staff, the employee or the staff who are counting these inventory, which department are they from? Ensure that they should not be from the warehouse department. These are what? These are tests of control. You're basically testing the internal controls during the count. During the inventory count, what are the different internal controls? You're testing them. Next, what are the substantive procedures that you do during the count? See, select a sample of items from the inventory count sheet and physically inspect them. You are also selecting some items from the count sheet and physically inspecting them to see whether they exist or not. Then you can do the reverse of this also. What is the reverse of this? You can select some sample of physical items and check whether they have been included in the inventory count sheet. Correct? So you can do the reverse, which will check for completeness. Next, inquire of management whether goods held on behalf of third parties are recorded separately. Any goods which have been kept in the warehouse of the company, but those goods are not the company's goods. The owners of those goods are some third parties. So ensure that those kind of goods are kept separately. They should not be recorded as the inventory of the company. Next, inspect the inventory being counted for any evidence of damage or obsolescence. Right? Okay. Next, record the details of last deliveries before the year end. See that the deliveries which have happened just before the year end, whether they have been included or not. Next, obtain copies of the inventory count sheets at the end, ready for checking against the final inventory listing. You will obtain a copy of that inventory count sheet. You will ask them to give you a Xerox. And lastly, attend the inventory count at the third party warehouse, where the goods, your goods have been kept at some third party's warehouse. Go and attend the inventory count at that third party warehouse also, because there also the goods of the company are being kept. Okay. Next, what do you do at the final audit? What do you do at the final audit? Read. Trace the items counted during the inventory count to the final inventory list to ensure it is the same and to ensure that any errors identified have been rectified. The inventory count sheet that you have, you're matching that inventory count sheet with the final inventory listing. The inventory count sheet, you're matching it with the final inventory list to see whether everything is matching and to see whatever errors which were identified during the count, whether those have been rectified or not in the final list. Okay. Next, cast the list to ensure arithmetical accuracy and agree the total to financial statement. The same point that we've been seeing in other areas also. Cast it for arithmetical accuracy and agree the total to the financial statements. Next, trace the goods received immediately prior to year end to the year end balances and inventory balances. The goods which were received just before the year end should be included in inventory. Check that. Next, trace the goods dispatched immediately prior to year end to ensure the items are not included in inventory and revenue. Right? The goods which were dispatched immediately prior to year end, that means which were sold immediately prior to year end, that should not be included in your inventory because those have been sold already. Next, inspect the purchase invoices for the name of the client. You are going to inspect the purchase invoices to see whether the name of the client is there or not. Inspect the purchase invoices for a sample of inventory items to agree the cost of those items. Check the cost of items from the invoice. Next, inspect the post year-end sales invoice. That means after the year-end sales invoice for a sample of inventory items to determine if NRV is reasonable. To see if the NRV is reasonable. Next, recalculate the work in progress and finished goods valuations using the payroll records for labor cost and utility bills. Recalculate. What was the amount of WIP? What is the finished goods valuation? You can recalculate. Do a recalculation. And lastly, you can inspect the inventory aged listing. What is inventory aged listing? As I told you, it will contain the list of all the inventory items along with their age. As to what is their age, so that you can identify any slow moving item, an item which has not been sold from a very long time, to see if it requires any allowance, if it requires any provision to reduce the value of that item, because that item might not be able to be sold at the same price because it has not been sold from a very long time. It's a slow moving item that you can get from inventory age listing. And next two procedures are analytical procedures, where you're comparing this year's information to last year's information with the help of two things: inventory holding period and gross profit margin. You're calculating inventory holding period and gross profit margin of this year and last year and seeing whether there is any unusual fluctuation. Analytical procedures that we've already seen while we discussed our evidence chapter, right? Any doubts in inventory? Do you have any doubts in inventory? No doubts? Okay. Let's go to the next one now. 1 second. Inventory is done. Next, receivables. Receivables, your trade receivables or your debtors. The receivables or your trade receivables or your debtors. Now, for them, for these receivables or for your trade receivables or your debtors, what are the different sources of evidence? See the different sources of evidence. Read them. So what are the different sources of evidence? One is aged receivables listing. Like we had aged inventory listing, like we saw aged inventory listing, there's an aged receivables listing also. What will be this aged receivables listing? This is going to basically contain the list of all the debtors, right? The breakup of all the trade receivables along with their individual ages. What do you mean by age of receivable? Basically, the number of days for which the amount is still pending to be received. The number of days for which the amount is still to be received. It will be calculated from when? From the date of sale. From the date of sale till today, how many days have passed by? That will be the age of that receivable. Because for those number of days, that is the number of days for which that receivables is outstanding. Right? So that is aged receivables listing. Next, sales invoices, because the receivables have come how? Debtors have come into picture because you've made some sales to them. So sales invoices, goods dispatch notes, GDNs, receivable circularization letter. What's a circularization letter? Confirmation letters. Receivable circularization letter is a confirmation letter. Remember, the bank confirmation letter that we saw. Similar to that, a confirmation letter. Next, post year-end bank statements for checking the valuation of receivables as to whether the value of receivables is appropriate or not. What do? You check post year-end bank statement to see what happened after the year-end. Have you received that amount which was pending? If you've received the entire amount, then the value is correct, right? If the company has received the entire amount after the year end, before your audit, that means it has been, the value that has been recorded, that value is correct. Okay. So let's see the procedures for receivables. That is test your understanding 4. So let me go to test your understanding 4. One second. Yes. See the audit procedures that we perform for receivables. Read the first one. Obtain the aged receivables listing. Cast it. What do you mean by cast it? Cast it for arithmetical accuracy. Basically, check the additions and subtractions that have been made, whether that is correct or not. And then the total of that listing should be agreed or should be matched to the financial statements. So agree the total of that to the financial statements. This aged receivables listing is nothing but like a breakup, right? Next, so obtain the aged receivables listing, cast it for arithmetical accuracy, and agree the total to financial statements. Next, agree the receivables ledger control account with the receivable ledger list of balances. The control account that you have, the receivables ledger control account, that control account agreed with the individual receivables ledgers. That control account agree with the individual receivable ledgers. Next, select a sample of year-end receivable balances and agree back to the supporting documentation. Select a sample of the year-end balances, the year-end receivable balances, and agree them back to see whether they have a sales invoice or not, whether they have a related good dispatch note or not, to see whether that receivables is actually existing or not, or have they just recorded a fake or a fictitious receivable. So to check that, what are you doing? You're selecting some sample of year-end receivables and tracing it back to their goods dispatch notes, to their sales orders. Great. Next, inspect the after date cash receipts. You're inspecting what amount have you received after the year end from those receivables, right? This is check for valuation. You check valuation like that. For valuation of receivables, what do? You inspect how much of the amount that is being shown as at the year end, how much is received after the year end. Because if the entire amount is received after the year end, that means that value is correct. That value which we were showing, that value is a correct value, right? So inspect the after date cash receipts. Great. Next, select a sample of good dispatch note, GDNs, before and just after the year end, and follow through to the sales invoice to ensure they are recorded in the correct accounting period. You're taking what? You're taking the good dispatch notes. The good dispatch notes which have been dated on or before the year end. The good dispatch note which has been dated 30th December, 31st December, those should be included in this year's sales. Those should be having receivables in this year's balance sheet, because the goods dispatch note are dated on 31st December or on 30th December. Don't don't miss out on recording them, and don't record them next year. They are belonging to this year, right? Those good dispatch note, since they are dated 30th December or 31st December, those belong to this year. So record them in this year. And the goods dispatch note of next year, don't record it in this year. Don't record the next year's goods dispatch note this year. Great. Next, perform a positive receivable circularization of a representative sample of the year-end balances And for any non-replies, send a reminder letter. What are you doing? You're performing a receivable circularization. What did I tell you? What was receivable circularization letters? Nothing but confirmation letters. Like bank confirmation letters, you have receivables confirmation letters. Those receivables confirmation letters are called what? They are called your receivables circularization letters. Receivables circularization letters. So these circularization letters, you are going to do what? You're going to basically see them whether that circularization letter is being received from the opposite party or not. Because if the circularization letters are not being received, that means what? That means that particular person probably does not exist. He might be fake. That person might be fake. He might not be existing only. So that is why, what are you doing? You're checking the receivable circularization letters, whether you're receiving them from that person. Correct? And if you're not receiving them, follow up. If you are not receiving any receivable circularization letter, follow up. Give them a reminder. Ask the client as to whether you can send a reminder or not, and send a reminder to the opposite person. Great. Next. Inspect the aged receivables aged receivables report to identify any slow moving items, slow moving balances, and discuss whether any allowance is necessary. Right? Whether any allowance for trade receivables is necessary or not. You're inspecting the trade receivables, aged receivables listing basically. That aged receivables listing is going to give you the age of that receivable, right? As to from what time is that receivables outstanding. Because if the receivables is outstanding from a very long time, if the receivables is outstanding from a very long time, then what will happen? Then you have to check whether any provision for bad and doubtful debt should be recorded. That provision for bad and doubtful debt itself is called what? Is called allowance for receivables. Is called allowance for receivables. So you're checking whether any allowance like that is required or not for the slow moving balances, the balances which are pending from a very long time. Next, you can inspect the customer correspondence in respect of these slow moving balances. What do you mean by correspondence? Communication. You can inspect the communication between the company and the client with respect to these slow moving balances, because for the slow moving balances, probably there might be a communication between the client and the customer of insolvency of the customer, or why is the customer not paying. Correct? The company might go and contact that customer, right, as to why is he not paying. So you can then inspect that communication between them. That communication is called correspondence. Next, you can inspect board minutes of Moore company to assess whether there are any material disputed receivables, to see whether there is any dispute with receivables. Next, inspect the receivables ledger for any credit balances and see whether they should be reclassified as payables. If there are any credit balances in receivables, in your debtors should have a debit balance, right? If there's a credit balance, means what? That means to that person you're selling goods and you're also purchasing goods from the same person. That is why that debtor is showing a credit balance. So see whether that should be shown as a payable instead of a receivable. Next, inspect the post-year-end credit notes to identify any that relate to the pre-year-end transaction to ensure they have not been included in receivable. What is a credit note? When do you receive a credit note? Or sorry, when do you issue a credit note? You issue a credit note in the case of sales returns, right? When there is a sale, but that sale has been returned, in that case, you issue a credit note. So they are asking you to see the credit notes of the next year to see if it is relating to sales of this year. If it is relating to the sales of this year, that sales should be nullified with sales returns and that receivables should not be there, right? Because that sale has been returned, because those goods have been returned. In case of sale return, you should reverse the entry of the sales. Basically, the receivables will not be there then. That amount should not be included in receivables. That's what you're checking. And lastly, you're doing an analytical procedure where you're calculating average receivables collection period and comparing it to last year to see is there any unusual fluctuation or any significant difference between this year and last year. That's about average receivables collection period. So these are the procedures that you perform for receivables. Any doubts? Any procedure that you did not understand? Any doubts or any procedure that you did not understand? No doubts? The forum is open to you because we have about 5 minutes. And of course, we cannot, in the last 5 minutes, I cannot start the next area. So we've done trade receivables. The next area is trade payables, which is a similar area. The points are going to be similar to what we've seen in receivables, but we don't have enough time to check them. We don't have enough time to go through them. So what we'll do is we'll continue this tomorrow. The procedures chapter, as I told you, is a long chapter. So this will be continued tomorrow, and we will continue with trade payables. Trade receivables is done. All right. So I will see you tomorrow, and tomorrow at the same time, let's meet at 2 o'clock. So 2 to 5, you will have your class tomorrow also. So come back at 2, and I will see you tomorrow. So bye bye. Thank you. Have a good day ahead, and I will see you tomorrow. Thank you.